Good morning from Los Angeles. This is this is reminding me of a Robin Williams movie. Good morning, Vietnam. It is exactly not Vietnam. It's Los Angeles. How you all doing? Hope you're doing well. Last week I figured out my microphone settings were wrong. I sounded like I'm in an auditorium, but today class is in session. So how you all doing? Hope your weekend was good. William, hello. Now, today we're going to go a little bit of education, a little bit of different topics. Education is going to be on options. Um, we're going to talk about the Greeks, the good old Greeks. Now, if you did get the book that I recommended for you guys to get, you would have learned about the Greeks. Well, start reading about the Greeks anyway. You must know about the Greeks. So I'm going to go into that, couple of different topics, share my screen, answer questions. The usual 45 minutes to an hour, we always go over. Yeah, I think Greeks are probably the most important thing when it comes to options. So let's go with the Greeks. Before we go into the Greeks, so I had explained 5, 6 different important keywords, right? Call options, we know what those are. Put options, okay. Expiration date. We have strike price, right? We have premium. We got coming couple of weeks. I'm going to go into different strategies with options. So we have premium, and we had implied volatility that we talked about. And today we're going to talk about the different Greeks. So the most important thing in an option, for me personally speaking, are two. One is IV, implied volatility. The other one is the delta. We will go through those. Don't get confused. You can also Google these things on the internet and educate yourself slowly, because they are complicated and they are not easy to understand. But as far as options are concerned, volatility or implied volatility represents the market's view of the likelihood that an asset's price will change, at what speed, at what pace, right? Now, here's a trick question for everyone. Can an option price double or triple without the underlying asset moving? I'll give you guys 10 seconds. 9, 8, 5, 3, 2, 1. Yes. Why? Because of implied volatility. If implied volatility is, for example, last week, implied volatility on GameStop, AMC, a lot of these things went absolutely bonkers, right? It went to 4, 5, 600%, especially with the zero DTE options. And we're going to talk about zero DTE options, how prevalent they are and how they add to the volatility. But this time, the market makers were ready. Last time, they were not ready. This time, they were ready. So what did they do? Immediately, they blew up implied volatility. But then people made a lot of money, because if you had bought an option for $1, stock did not move. GME, let's say, GameStop, but then implied volatility exploded to 500%. Well, the option went from $1 to $3 without the stock moving, and then the stock started moving. But what do you do when implied volatility explodes like that? Well, if you're long options, right, calls, let's say, while GameStop's going crazy, you're making tons of money. But on the other side, what happened to the meme boys at the end of the week? They all became bag holders, right? Because they bought all those options with extremely high implied volatility. When implied volatility goes through the roof like that, and if you end up buying options instead of selling the premium, what's going to happen is that the underlying stock then is going to keep moving your direction and within your duration, which is expiration, but the options will not move because they already have been priced for the anticipated move. So what did I do? I sold premium, right? I sold AMC $20 June $20 calls for $4, $5 while the stock was 8. Somebody was buying those at $4 or $5. Within 3 days, guess what? Where were they? 25 cents, right? So they all became bag holders. So implied volatility, in general, volatility is extremely, extremely important, something you guys need to pay attention to. So we're going to add 3 more keywords besides implied volatility. So we're going to add at the money. We're going to add in the money. And we're going to add out of the money. Now, that's a quick explanation. Let's say stock is $10 a share. If you're buying the strike price of 10, that is called at the money. You are right at that level. In the money means, let's say the same stock, XYZ stock, doesn't have to, or ABC stock, doesn't have to be anything specific. If the stock is at 10 and you're buying the $9 strike prices or $8 strike prices, then that's called in the money. Okay. And conversely, the opposite would be if you are buying out of the money options. Okay. Let's say again, the stock price is 10. If you're buying 10, 11, 12, 15, $20 strike prices, that is called out of the money. And we're going to add two more keywords. I know this is complicated, but bear with me here. There's two values. Okay. Two values in options. It's called intrinsic value and extrinsic value. See how complicated this is? It took me, with all my degrees, it took me 6 months to learn this. But then when I learned it 30 years ago, and you never forget it. This is like riding a bike. But that's why I keep harping on what? Building a solid foundation. Without a solid foundation, what's going to happen? You don't know any of this. Well, I know all of this. I'm going to eat your lunch before your dinner. So you don't want that, right? So intrinsic value means, let's say, in the money options, right? A stock price is at 10, you're buying the $8 calls. Well, those options are already worth $2, the difference between 10 and 8. That's called intrinsic value. So if the option were to expire today, the intrinsic value of that option is $2. The extrinsic value is all these other things, right? The premium that you're paying. If you're buying an out of the money option, as we discussed, let's say the stock is at 10, you're buying the $12 call options for $1, right? That's all extrinsic value because the stock is not 12 yet. Once that stock goes from 10 to 12 to 13, then your $12 call options are going to have $1 worth of intrinsic value. Everything else is time premium, right? You're basically buying time, okay? I know I'm going to go on through fast, but you guys can watch the replay on this. The third thing is the key takeaways, okay? What are the key takeaways? And options Greeks describe its various risk parameters. 100% agree. Now, delta is the one that I told you guys to pay attention to, right? Okay. The delta is a measure of change in an option's price or premium resulting from a change in the underlying asset. So let's say we have that $10 strike price, okay? You bought the $10 calls for $1, okay? The delta is immediately known. By the way, on a lot of platforms, all this information is given to you for free. Like, let's say Robinhood or Coinbase or Thinkorswim or Schwab or, Ameritrade, whatever. So when you're setting up your option chains, remember the option chains we talked about last week, right? I showed you the pictures. You need to set these Greeks, at least couple, 3 of them, okay, to understand what you're dealing with. Because you don't want to buy an option willy-nilly with 500% implied volatility. And you want to buy the option that's the most favorable delta, gives you the most favorable delta to you. So going back to that example, stock is 10, you're buying the $10 calls for $1. The delta on that is most likely going to be about half or 0.5, meaning if that stock moved $1 from 10 to 11, the delta measures how much that option that you bought for $1 is going to be worth, right? So for every dollar move in the underlying asset, it's going to tell you what the expectation is for that option to go if you pay attention to delta, okay? And then the second one is going to be theta. Theta measures its price decay. Price decay meaning time decay. There's going to be a decay. So let's say you buy a stock, you buy an option at 10, stock is at 10. If that stock stays at 10, you're paying a premium, right? Remember the word premium? That premium is going to start decaying every single day because stock is not moving in your direction. And you're losing daily premium on that, and that measurement is called theta. Gamma which I explained to you guys in GameStop and AMC's case, there was a gamma squeeze, we called it, and I explained that to you guys. Please go rewatch the old lives or some of the segments that we're putting up. Gamma measures the delta's rate of change over time, as well as the rate of change in the underlying asset. So what happened in GameStop's case is that people went and bought all these hundreds of thousands of out of the money options. Well, they started squeezing the gamma, right? So what is the market maker going to do? Well, as soon as they sell those options, because somebody has to make a market and sell them to the buyers, they start buying the underlying asset, which is the actual equity itself. So they squeeze the gamma, right? Gamma measures the delta's rate of change over time. So they're all correlated, okay? Please, before you understand all of this, by the way, the other thing is I said keep it simple, stupid, right? On options, you must understand this. Now, for me, the most important two things you have to pay attention to is implied volatility, okay, and the delta. Gamma, yes, when things like that are happening, like to GameStop and AMC, right? Gamma measures the delta's rate of change over time, as well as the rate of change in the underlying asset. Vega measures the risk of changes in implied volatility. So they're all correlated, as you guys can see, right? Or the forward-looking expected volatility. So all of this is correlated. When one moves, obviously the other one is going to move as well. But without going into it too deep, right, it's going to be all in your option books. What I want you guys to do is get comfortable with the lingo, first of all, before you even try to understand it. And there are a lot of keywords now we're squeezing into this, right? But at least today, without the Greeks, add out of the money, at the money, in the money to your lingo, okay? Then we implied volatility we talked about, and the other 6 that we talked about in the past. So this is the Greeks. If you're not getting it, do not worry about it. It's not an easy thing to get. And again, you don't have to pay attention to each one, because on your platforms, when you log on and create an option chain with one click, all this info is going to be given to you, right? Implied volatility, theta, gamma, delta, all of this, and they're all correlated. So with that said, I'm going to end this segment here, but don't get stuck on the language. Don't get stuck on what they do. Get comfortable with what they mean first, and how one affects the other one. Okay, but pay attention if you're going to trade options. Pay attention to why are you paying such high premium for something, because of implied volatility. Literally, options can go quadruple, quintuple, go up 500-600% without the stock moving, right? Meaning, the more buyers come in on the ask side on an option, right? What's going to happen? The market maker is going to start pumping up the implied volatility, because they don't want to take the risk. They want to mitigate risk, right? And it's going to cost you. So don't ever buy anything with 3, 4, 5, 6, 800% implied volatility, because the time decay, as we talked about, right? The theta is going to kill you. Then the stock will keep moving towards your direction that you want to move, but then your options are not going to appreciate. Actually, they may even depreciate, right? So with that said, I'm going to leave that there. I'm going to go to the next topic. I'll answer some questions if you guys have it on this subject. So today's actually headline of the Power Hour, right, is there a correlation between what the Fed is doing, and you guys know how much I love the Fed, is there a correlation between what the Fed is doing and the stock market, right? Well, this is from the, this is clearly kind of explains what's happening here, right? So in the chart, you guys have 2 lines. One is the orange line. The other one is the blue line. The blue line is the S&P 500 going back to 2010, okay? On the left side, on the lower left, you guys will see the 2010 and the price of the S&P 500, right? 1,000, 2,000, 3,000, 4,000. Now we're at 5,000 actually, if you were to update this. But you guys also will see the correlation between the orange line, which what the Fed is doing. Remember the printing machine, print and spend, print and spend, print and spend, right? Okay. Well, there are times in history that the Fed has to do this to save the economy, like in 2008, great financial crisis. They should have let the banks die. They didn't, of course. They printed $800 billion, right? If you guys can see that spike right at 2020, the market took a swoon, obviously, but then came right back. But what did the Fed do this time? This time they printed $5 trillion to save the economy from the abyss, right? And sure enough, the S&P always responds positively to that because there's money pouring into the economy, right? I mean, basically free money. So you guys see the correlation of what's happening here, right? So in 2020, that orange line spiked from 4 trillion on the right-hand side. You guys see 1, 2, 3, 4, 5, 6 with dollar signs. Each one, those are in trillions, not billions, trillions with a T, okay? So Fed pumped from 3 trillion to about $8 trillion, $5 trillion into the economy. And sure enough, S&P definitely responded. Now we're in the phase of Fed killing the inflation, meaning weaning off all these trillions in dollars they're putting into the economy. Is it an easy thing to do? Absolutely not. And look at this correlation though, right at 2022, because we have the inflation problem, right? The Fed said we're going to reduce our balance sheet. That means they're going to suck liquidity out of the markets, right? Well, what did the market do in 2022? Absolute took a dump, right? About 30%. You guys see that downtick over there, right? Well, if you just kind of figure out what the Fed is doing with the money supply, how much they're pumping into the economy, how much they can taken out of the economy, you can literally now fundamentally understand the effect or the correlation of the Fed balance sheet versus the S&P 500. Can you trade it on a long-term basis? Yeah. But another reason, by the way, the market always has gone up. Yeah, it has its dumps, it has its shitters, or temper tantrums. But every time this happens, Fed pumps, right? Money into the economy because they have to. Guess what? Why? Everybody's 401k, everybody's IRA, everybody's pension plans, they're all in the stock market, right? Fed cannot, that's why it's called a Fed put. So Fed is basically sitting there with their hands open and saying, look, we're going to do everything we can for the market to be stable because we cannot afford everybody's retirement to go into the shit, right? And so, but then on the other hand, now what are they doing with all this pumping? They create this animal called inflation, and which I talked about on a segment, the video we put out this weekend, I think. Well, to kill inflation, what is the Fed doing? Raising interest rates. What is that doing? Sucking money out of the economy, right? Everything has become more expensive. Initially, they did create this animal called inflation. Now they're trying to kill that animal by raising interest rates and lowering the balance sheet, Fed balance sheet. At the moment, the Fed balance sheet stands at $9 trillion with a T. Look at all the way back to 2010. Where was it? About $1 trillion, right? Ninefold increase in, I don't know, 14 years. But uncanny correlation between S&P 500 and what the Fed does exists. So you guys have to go to where? Remember, we talked about FRED, F-R-E-D, Federal Reserve Economic Data. I showed you guys where, you can Google it and go to that. And all these are there, what they're doing with the money. They're pumping, they're, pumping liquidity, adding liquidity, or they're sucking liquidity, okay? The way they suck liquidity is by increasing interest rates. Because if you can get 5% guaranteed money on a 3-month treasury bill, why would you go open a business, right? That's how economy slows down. That's what they're trying to do. They have to slow things down, and they have to take liquidity out for inflation to go back to their target of 2%. Are they going to be successful? Time will tell. So, and here is the one. This is the episodes that we've experienced. This is the Fed balance sheet and the S&P 500 again with these bubbles. 2007-8 financial crisis. Look what happened. They spent $800 billion under TARPs to save the economy, to save the banks, right? Another crisis came, the Eurozone crisis, right? That's when they pumped again massively, right? And look what but then you guys see the trajectory of the pump, right? In 2008, look, every 10, 12 years, there is a crisis. It's called Black Swan. I talked about it. What is it that the Fed is doing? Pumping money, creating money to save things that are going into the abyss. In 2008, they only had to pump 800 billion. Look at the one in 2000, right? In the Eurozone crisis. Look at the trajectory of that pump, right? And then it kind of flattened out. And as soon as it flattens out, you guys see for a long period of time, right? What happens? Market still goes up, but not at the level that when the pump is in, okay? And then look at 2020 during the pandemic. Look what the market did. Absolute tank, 40% in about 2 months, right? But then look at that pump. So when you guys see that pump in action, buy stocks, because the Fed is saying this is it. This is the floor. I'm putting a floor into this. And one other thing that my mentor have always told me, even 30 years ago, do not fight the Fed. Don't fight the Fed. You will be killed. You cannot fight the Fed. You cannot fight something that they can create money like monopoly out of thin air and pump it into the economy. You just can't. So you got to go with the flow, and that goes back to trade like with the trend. And then look what the S&P 500 did. Doubled literally during COVID and after COVID, because the pump continued. The pump continued. See the blue line keep going up? Now, when did the market take a hit, right? The inflation unwind. Well, they created the inflation. Now they're trying to unwind now. Now you see the blue line kind of going down, right? Well, blue line going down, by the way, there is a lag in this. There is about a 6-month lag, right? The market is always ahead, people. Market is always 6 months ahead. Stocks are always 6 months ahead of their earnings. The indexes are always 6 months ahead. How does the market know that? Market knows that, so that's why you don't question the Fed, and you don't you can question the Fed, but you never question the market. Market knows best. The price is telling you something, okay? And sure enough, when the market took a dip of 30%, but now it's back to all-time highs, we're going to find out if they're going to pump now, because there is absolutely not rumors. There is, talk that the Fed is going to start cutting rates because these high interest rates are killing the market and killing the consumer. Since we are 75% dependent on consumer spending, our GDP, that's what they're going to do. We'll see. And that's why I don't think they're going to be able to kill inflation to 2%. So this is that segment. And then I'm going to go into my next segment. This is something that I read that absolutely hit me from left field. Okay. You guys know who Bill Ackman is? Billionaire hedge fund trader. He was in Herbalife. He got into a tussle with Carl Icahn. He was short. Icahn was long. He lost a whole bunch of billions of dollars. But he likes effective altruism. And, I'm not saying I like Bill Ackman. I don't agree with much of the stuff. But he said this in the news the other day. Okay. We have a massive, massive, massive retirement problem. I'm going to retire in like 10 years, legally. I don't think there's going to be money for me to get out of the Social Security, because the politicians have raided the Social Security fund. There isn't that much money left. There is definitely not much money left for my kids, for sure, right? That's why it's important for you to take care of your own retirement. IRAs, 401ks, if you have a W-2, all these things you have to do. If you're an independent contractor, you have to have a SEP IRA. You have to start saving money for your retirement, personally speaking, right? So Bill Ackman said, and this, I'm on board with this, okay? Just like I'm on board with, on Bitcoin with Michael Saylor, I'm definitely on board with this one. So Bill Ackman has a solution for America's retirement crisis. Okay. So for every child that's born in the United States, he wants the government to open a retirement account and give them $7,000 for every baby that's born in America. Okay? Hear me out on this one. I'm going like, wait a minute, we already have enough budget deficits. Why do we need to do that? But then it hit me. The numbers I'm going to read of this article, because I didn't want to memorize it, but they're very clear. So they say the best time to start investing was yesterday. Agree. What if you could harness the power of compounding, which we talked about on a video on the channel, even before you understood it or knew what a retirement account is? Okay. Billionaire hedge fund manager Bill Ackman once proposed a creative solution to the U.S. retirement crisis. Give every child born in America $7,000 investment account. Okay, it's a 7,000 birthday gift. So his thing is the 7,000 birthday gift is not going to be touched ever. Well, not ever until they turn officially retirement age, which is 65 years. And it's going to be invested in the index S&P 500. Okay, that's it. Now look at the power of compounding. Ackman's plan is for U.S. government to place 7,000 into an account created every child at birth. To be clear, this isn't a cash grant. He believes the account must be restricted from withdrawals and also tax exempt. 100% agree. This is not gambling money. The money must be invested into an index fund and left alone to compound until the baby is old enough to retire, says Ackman. Okay. He estimates that these accounts could be worth, yes, it could be, because if you figure that out, 7,000 compounded at a S&P return of average 9 to 10%, including dividend reinvestments, yes, it will get to $1 million. Now, what will $1 million be worth in 65 years? Can you buy a loaf of bread with it? I don't know. But look, if I told you this 65 years ago, would you not rather have 65 or $1 million plus in a retirement account when you're retiring today? I mean, yeah, $1 million doesn't go that far anymore, but I absolutely would. I think this is brilliant, right? So there were 3.6 million babies born in the US in 2021, which means that such a program would cost the government around $25 billion. You guys may say, oh, it's going to add to the deficit. Hold on a second. You know what an F-22 Raptor costs these days? Do you know what our military budget is today? $650 billion, right? This is only $25 billion into the future generations' pockets. I'm all in, okay? $25 billion a year, assuming the birth rate stays steady. And it has stayed steady in the US. By comparison, federal spending in fiscal year 2024 on transportation, commerce, and housing credit, Social Security, national defense has been 60 billion, 65 billion, 715 billion, and 433 billion. Don't you think our children deserve like this? I think this is brilliant. Okay? And then I am on board. You guys are on board? Where does all the magical money come from, Megan? But I'm going to answer questions now. So before I do that, these are the 3 segments. Hope you guys enjoyed it. I'm going to go share my screen with you guys and see what's happening in the world of high finance. Let's see. What is happening? Well, I am okay. Let's take a look. This is a falling knife, people. You guys see the falling knife here? Yeah, you don't want to mess with this. And so what happens? So we talked about the market. Markets actually, started to sell off while I'm actually doing this. Do you guys see this? On what's happening to the triple Qs? Triple Qs meaning the NASDAQ 100, right? So this week we have earnings coming out on NVIDIA. It's going to be important. Please. I think it's going to be on Wednesday, but check your, check your calendars. If you do have NVIDIA, it's going to be a volatile, interesting week, I'm pretty sure. On top of that, now, I talked about on Friday about my stocks. It's Monday. I have a couple of positions. I'm not going to take too many positions in my actual trading account. I may day trade a few things here and there, but we'll see. We'll see where things are going to be at the end of the week, which Friday recap will come in. No small account. I'll let you guys know what I'm doing. So with that said, if there's any questions, I'm going to go answer the questions. Oh, actually, you know what? I want to talk about Bitcoin. What am I saying? Let's talk about Bitcoin. Bitcoin is moving. So is MicroStrategy. Remember the Bitcoin surrogate? Actually, I wanted to talk about this. So this is MicroStrategy up another $81 today because Bitcoin is about 67,000. So I told you guys I'm long the 3,000 calls. They have like quadrupled already. I'm out of it. The reason I'm out of it is MicroStrategy, as much as it is a surrogate for Bitcoin, it sells at a massive premium. So you guys have to figure this part out too. MicroStrategy stock right now is at 1,666. Is that an omen? I don't know. $1,666 a share, right? They have 15 million shares outstanding. So if you multiply 1,666 times 15 million shares, the company is worth about 25 billion dollars with a B, right? But they only hold 215,000 Bitcoin. If you multiply 215,000 times, right, 67,000 that Bitcoin is today, that's about only 15 billion. So the stock actually has gone up more than Bitcoin has. So that's why you got to be careful with MicroStrategy. If you're using it as a Bitcoin surrogate, it is 10 billion premium is too high. So what's going to happen is Bitcoin may go to 75,000, but MicroStrategy is not going to move. So you have to do this calculation. If you're trading MicroStrategy, you have to really, really understand what kind of premium is selling over its existing portfolio of Bitcoin, which is 215,000 of them. The point I'm trying to make is when the premium gets too high, right, or the gap gets too high between the stock price and Bitcoin, you need to be careful. So that's a warning. The other thing that I want to talk about is the price of Bitcoin. So I'm going to, let's see. Yeah. I'm going to try to share my Bitcoin chart, and which is coming up right here. Okay, Bitcoin. Here's Bitcoin. Well, there's Bitcoin. So you guys can see that, right? So what is Bitcoin doing, right? I have right at the moment it's 67 and change, right about there. This is free charts. You guys can do this. Actually, I'm wrong. Bitcoin right now is 68.3, so it's up another couple $1,000, right? So hope you guys are seeing this. I don't know if you guys are. Chris, are you seeing this? Are you around? This is the 1-year chart of Bitcoin. Let's go back a little, 9 months. So Bitcoin, remember technical trading, right? You guys talked about, we started with that. Clear uptrend. It went from about 37.5 to 72.5. Then it's been consolidating since actually like start of March, right? So I mean, on a breakout, this thing is going to go. This thing is going to go to 110. That's the measurement, 110,000, right? But I'm looking at the volume. It's pretty anemic. So this last move is not coming in like really, really strong volume. So in my book, I think it needs a little bit more digestion to do, consolidation to do. Look, I said this, 10% of everybody's net worth should be in Bitcoin. Is this a trading tool? Absolutely not. This is like set it and forget it, or buy it and forget it, and then dollar cost average into it if you don't have it. The MACD is turning up on this. Technically, I have 3 moving averages, as you guys can see, the 20-day, the 50-day, and the 200-day. The 20 and the 50-day are just kind of crossing back and forth. I like the chart. I think it needs a little bit more digestion, but if it breaks 72.5 on the upside on good volume, it's going to hit 110. So my opinion on Bitcoin and what's happening with MicroStrategy and Bitcoin. So you guys be clear on that. Do that calculation on MicroStrategy if you're going to jump on it. Okay. All right. So let's look at some questions. Let's see. What do we have here? Okay, good afternoon. Hello. Where does this magical money come from? Would this mean sending less money overseas? Well, I wish they did that. How much money did we send to Ukraine and Israel so far? Okay. How many hundreds of billions of dollars, right? 25 billion is chump change, Megan. It's like not even a drop in a bucket, right? Yeah, all your questions are valid. How come they don't teach investing? How about giving free education? I mean, I like it. It would change kids' future for a lifetime. Yeah, but how about this? How many people in the US who are independent contractors or or even working with major companies have retirement funds, right? You cannot trust the government with your money and your retirement money. You just can't. I mean, they're raiding that the Social Security fund on a daily basis. And then they have to borrow more money to make it whole so they can pay all the millennials. About 70 million millennials, baby boomers are going to retire in the next 15 years. Where's the money? I don't think it's there, right? So yeah, this magical money, how about some more print and give to the people, as opposed to sending weapons and having a $600 billion defense budget. I'm not against defense. I believe in strong defense, but we can find $25 billion. Not that much. Look, our national debt is $35 trillion. What's 25 billion between good friends? And I think it's a great cause. And I think, it will solve a lot of the retirement problems of people in this country. So hello, everybody. I mean, we may have to cut it short today. California does this with a college fund now. Yes. Look, all these things are good things. But I think what Bill Ackman said, giving, a newborn 7,000, I think is really, really valuable. I mean, it hit me the right way, and I'm going to support it. Not a bad thought. Okay. I love the perspective Sergio offers with the graphs. Thank you. Much appreciated. I mean, look, for me, picture's worth 1,000 words, right? You gotta have some sort of proof. You can't just, blurt some stuff on the internet and then it'll go somewhere and then, it doesn't make sense. I mean, look, by the way, if I may give it a plug, please share this, and we're going to put the video up hopefully this week. I'm doing one-on-one interviews with traders, OGs of trading. I'm talking original gangsters or goats of trading, okay, from the people of my past. I did the first episode of, we're going to call this the Insiders, okay, or the Insiders of Trading. We're going to decide with Chris what to call it. What do you guys think we should call it? These are all truly, truly amazing traders. And today I interviewed Mr. Jack Barugian, who you may have heard was a CNBC alum, right? He was on CNBC for about 11, 12 years. He started trading in that room back there. And I had an amazing interview on episode 1 today. And I'm going to do another interview with him because we couldn't squeeze everything into one episode. He's an amazing, amazing, amazing man, amazing career. Now he's retired playing golf in Chicago. He started in the Chicago Board of Exchange and Chicago Mercantile Exchange, and he became the president of Commerce Bank, and he set up a lot. And he was on the board of CME, Chicago Mercantile Exchange. Talk about experience. I think I have experience. This guy has like 10x experience I have. But we have a lot of similarities. We've been good friends. And I'm going to put his first episode, the inaugural episode of The Insiders, on the channel. Hope you guys enjoy it and watch it and share it, because there's so much wisdom in what that man said today. So that's my plug for my own show. Let's see. Melvin says, yeah, I think so. 25 billion is nothing, really. Good idea, but can't trust Wall Street. It seems like you've been burned. I don't know. I mean, you're not trusting Wall Street by putting that $7,000 into an ETF or an exchange traded fund. S&P 500 over the last 100 years has gone up on average 9 to 10% a year, including dividends. So, you're not really trusting Wall Street. You're trusting the US companies, because S&P 500 is the largest 500 companies in the United States. So if you don't believe the US, you could say that, okay, I don't believe any of these companies. It has nothing to do with Wall Street. What does Amazon, Google, Meta, Nvidia, all these, Apple, all these wonderful companies have anything to do with the US government? They're private entities, and you're investing in those companies. I mean, but then to each their own. Some people do, some people don't. Let's see. Most people don't pay enough attention to absolutely $1,000,000%. And then they retire. They want to get money from Social Security. And Social Security adjusts, by the way, with COLA, cost of living adjustment, but it's garbage, right? And I mean, look, your money is losing 7% of value every single year. That's a fact. Government may say there's only 3% inflation. It's not true. It's about 7%. Okay. So if you had $100 12 years ago, 12 times 7 is 96, I think, or 98, something like that, whatever. Or 94. So in 12 years, that $100 bill you had in your hand is worth nothing. So you have to keep pace with inflation. What do you have to do? Look, that's why real estate has done what it's done. It's not because the intrinsic value of real estate has gone up. It's because of inflation. It's an inflation hedge. That's why gold is doing what it's doing. That's why Bitcoin is doing what it's doing. People are not trusting the fiat currency. US dollar is losing value constantly. So there you go. Okay, let's see. Melvin says the money is given overseas, goes back into defense. Yes and no, yes and no. But then it's very condensed, right? How many defense companies are out there? 10, 20, 30, right? It's going back to private entities, right? It's being taken out of taxes by the government, and they're buying these weapons and sending it overseas. Well, that's the wealth transfer we've been talking about, right, Melvin? So I don't see anything wrong with government giving every newborn $7,000. Okay, Daniel says to Luis, I think the bigger concern is that you would have a cohort of retirees that benefit. Yeah, the business cycle is, the business cycle is the business cycle. Daniel, by the way, is a PhD student, an absolutely brilliant kid. I call him kid because he's a lot younger than me. He's not a kid, but yeah, I agree with him on that one. Let's see. Would Bitcoin mining companies always move? Yes and no. Actually, I follow about 3 Bitcoin companies. One is Marathon. That's the symbol, Marathon Mining. The other one is Riot Mining, ROIT. And then there is CleanSpark, CLSK. Those are the 3 I follow. Those are the best miners out there, right? That have the funding, and they're doing it the right way. Even if Bitcoin gets halved, those miners are not doing it. But there is a little bit of a correlation between Bitcoin moving up and those stocks moving up. In fact, if you guys can see my screen, I'll put them up. Here is Marathon Mining. Let me make this big. I mean, today it's up massive because Bitcoin is about to break about 68 and change, right? It's up over 11%, at 2168. But this is one of the stocks that was in my group on Friday. You guys can go watch that. This was in one of my watch list stocks, right? I said, here's a little
just real
channel.
quick, you'll need to share your screen.
Oh, I'm sorry. Yeah, typical. Share my screen. Sorry. Okay. Boo. Chris, can you have to pound me on this finding the second screen and share it, buddy, because this is too much work. Okay, here it is. You guys can see it now. So this was one of the stocks that I'm on my watch list. It's in a channel, right? This channel right here. So it's going to the upper end of the channel. So if you look at this versus, I'm going to show you MicroStrategy, which is the Bitcoin surrogate, right? Bitcoin goes up, MicroStrategy goes up. Bitcoin goes up, Marathon does not move that much. This is Riot platforms, which is another miner. Look at it, right? It was 18, came down all the way down to 8. Now it's like about 10 and a half, right? Why is it not moving with Bitcoin? The halving may have something to do with it. And this is CleanSpark. This is another one that I follow. This is doing better actually than Riot. So Marathon and Riot are about the same. So you gotta be careful with these miners, right? They have a lot of debt that they do to mine Bitcoin, and every time it gets halved, they're going to get half as much, right, for their work. So, but these 3 I follow. These are the ones that I think are the best position for Bitcoin appreciation game. But for my money, I think the best one is MicroStrategy. But again, watch that premium. Please watch that premium. Don't go willy-nilly buy MicroStrategy or whatever else it is. So let's see. Other questions. We have a couple more minutes. Now more than ever. Okay, Melvin is preaching today. Now more than ever, you have to invest for your future. Yes. Yes, Melvin. I agree with Melvin 100%. If you're lucky enough working for a corporation for 20, 30 years and you had a nice 401k and then you also did a SEP IRA on the side, you're okay, because Social Security money is not going to be worth much when by the time they give it to you. So if there is no other questions, we're going to turn it off today. Thank you for joining, and join me again on Friday for Power Hour number 1, 10 p.m. 10 p.m. shit, 10 a.m. Pacific, 10 a.m. Pacific, 1 p.m. Eastern. Again, 10 a.m. Pacific, 1 p.m. Eastern, Power Hour, Mondays and Fridays. The Insider is coming up. Are we going to call Insider, Chris, or Insiders of Trading?
Not sure yet.
Okay, we're not sure yet. We'll surprise you guys with that. Definitely must-watch interviews. I'm telling you, it's
real quick, just to put this in perspective, because I don't think I heard you say this. They are expecting that as everything remains the same, that Social Security will run out no more in 2033.
Yep. The fund is going to run out of cash. So what is the government going to do then? Right? Remember, the printing machine, they're going to print more, inflate more, and, make because look, people have worked 60, 50, 60, 70 years, right? Well, it's coming due. That's what I said, right? The baby boomers by the millions are going to retire in the next 15 years. Where's their money? Why hurt these people, right? I mean, the money they're going to get out of Social Security is not going to be much anyway, right? So to me, it's injustice that's being done that nobody talks about, but Chris is right. By 2035, I think the fund is going to run out, right? And then the government, so 25 billion versus hundreds of billions they have to print to make Social Security funds whole, because the politicians raid it every single goddamn year. It's like a candy, I don't know, candy bucket. They just stick their hand and take it out and never put it back in. I mean, what happens in this country is just ridiculous, right? So, yeah. Okay. Oh, there's a question. It's one of my stocks. Sleep Number is having a vote to increase number of shares. Yeah, they do that, but not necessarily. Dilution is never good for an equity. We know that. But the reason they do that is because just because they're saying they're going to vote on increased shares does not mean they're going to issue those shares. They call it shelf registration. So if the stock goes up, doubles, triples, let's say, then at some point they may issue those shares. So it's kind of meaningless, really. If they announce the secondary offering immediately, that means they're going to dilute. Yeah, that's not a good sign. But if they're just voting, the voters, the shareholders are voting to increase the shares, nothing wrong with that. They're going to issue a shelf, and at a certain time, all companies do this, by the way. They issue shares to put more money in their treasury, to invest more, to expand the business more. So instead of going into debt, that's what they do, issue equity. So it's not that big of a deal. Please smash the like button on the way out, all 20 of you, and please share the word. I mean, I think I'm doing good work here, and the channel is growing, but we need your support, and we need word of mouth advertising, and who can do that better than you all? So thank you for joining me today, and we're going to end it a little early because there weren't that many more questions in there. Were there? Did I miss anything? No, you all are being shy. Okay, so summarizing, please go read your books on options, start learning the Greeks. I have allergies going crazy. Pay attention to the Greeks, pay attention to implied volatility, pay attention to what you learned today: in the money, out of the money, at the money. We're adding, to our vocabulary. Hopefully you're learning about technical trading. That's it for now. Peace. Stay healthy, stay wealthy, and stay safe out there.